Hey everyone, Bill Lethman here for MoneyEvolution.com. In this video, I'm going to be talking about where to find money to fund your early retirement. So if you're planning on retiring early, especially if you're planning on retiring before age 62, the earliest you can collect Social Security benefits, or even retiring prior to age 59 and a half, when you can start taking normal distributions from your retirement accounts, I think there's a couple of very specific things that you need to think about in terms of how you're going to get the money to fund your cash flow needs, especially in those early years. So when we think about retirement account assets or money that you might have that you're going to use to fund those cash flows, there's really three main retirement tax types. You have non-retirement account assets. That's money that's not in any 401k plan or IRA accounts. It might be cash balances at the bank. It might be mutual fund accounts, again, that are not part of any sort of retirement account balance. You might have traditional accounts. It could be a 401k plan, or it could be a traditional IRA account, maybe some money that was rolled over from a 401k plan. And that's money that ultimately you're going to have to pay taxes on when you take any distributions from that. And then finally, you might have some Roth account balances as well. So that's money that could be a Roth 401k plan, but that's money that's going to be tax-free as it comes out. But there's going to be some special rules as it applies to all three of these categories. In fact, actually, I get into that in a lot more detail in one of my other videos where I talk about those three tax types as it pertains to your retirement savings. So what we want to do, the first thing you want to do anytime you're doing any retirement planning, is you want to understand what those cash flow needs are. So if you've gone through some income and expenses, kind of map that out, you hopefully, before you pull the trigger on your retirement, have a pretty good idea of how much you might need to withdraw from these investment accounts to meet those cash flow needs. So obviously, if you have any money that's in non-retirement account, that's probably one of the easiest and one of the best ways to get money out because you don't have to pay any taxes as you would as you take out money from a traditional account. There might be some capital gains taxes if you bought an investment and it's grown in value and you're having to sell that at a gain. You might have to pay capital gains, but fortunately, as long as it's a long-term capital gain, you're taxed right now at a 15% tax bracket. So that's a nice feature there where you could get that money out at a little bit lower tax rate. If you've got money in traditional accounts, there's going to be a couple of different options that you could tap into. One is if it's a 401k plan, and this only applies to 401ks, there's something called the age 55 rule. And so if you retire on or after your 55th birthday, you can actually take penalty-free withdrawals from a 401k plan and not be assessed that 10% penalty. You only have to pay the income taxes on that. So before you go and roll that 401k plan over into an IRA account, if you're doing this early retirement and you've met the requirement for that age 55 rule, that could be a very good option. Another option there is something that applies to only IRA account balances, and this would be traditional IRAs, and it's something called 72T. And 72T is something that you can take at any time. You can even retire as early as 50 if you want, or 45. And what the 72T regulation pertains to, it's a section of the IRS tax code that says that if you take out what are called substantially equal payments and then continue those payments for the greater of either 5 years or until you turn 59 and a half, they'll waive that 10% early withdrawal penalty. So 72T is an option. It's not my favorite option because it is very restrictive, especially if you start this at an early age, say at age 50, you'd be locked into those 72T calculations for 10 years until you turn 59 and a half. So that could really limit some of the access that you have with the money. But again, plan properly, that could be another way to do that. Another option could be as it pertains to Roth. So one thing that I really like about Roth IRA accounts is that you can pull your cost basis out of a Roth IRA at any time. So let's say over the years you contributed $100,000 to Roth IRA accounts and now that account's worth $200,000. At any point you can pull that original cost basis, that $100,000 out of your Roth account and pay no taxes and no penalties from that account. So there's another option there. So as you start to plan this, you want to really understand where the cash flow is coming from. Again, as it pertains to these three tax types, what we want to look at is, kind of the least desirable area. So that's why this makes the sense to use that money up first, because we've really got no long-term tax deferred or tax-free benefits on these non-retirement accounts there. Use the traditional accounts second if we can. because that's money that the more that grows, that's really raising that future tax bill. And then the Roth account is really the money that we want to spend least. And sometimes people immediately go over here to the Roth bucket because they can pull that money out, pay no taxes on those distributions, and use that to fund their retirement. But they might be giving up a lot on the long-term end of things. So you want to really kind of map that out, figure out how that works. And a couple of other things too to consider as you're looking at this early retirement is I would strongly discourage you from tapping into, let's say, a pension plan early if it means you're going to take a big penalty hit on that. So sometimes pensions are really designed to pay out after age 65, but you can take it early, maybe at 60 or 55 years old, but it's at a substantially reduced rate. So I'm generally not a big fan of that. We want to do some number calculations on that, but I would discourage you from taking the hit on that pension benefit. Same thing with Social Security. You can take Social Security benefits as early as age 62. Sometimes that can look very attractive as it pertains to how it's going to solve that cash flow need. But again, taking Social Security benefits at 62 reduces those benefits for the rest of your life. It also reduces your spousal or your survivor benefit for your spouse if something should happen to you. So there's some negative there as well. And then the last thing I want to tell you about as well that you probably know is working part-time could be a great way to fund this also. And really for a lot of the clients that we work with, the clients that retired from their main job but then do some consulting or maybe do some part-time work, they've got some cash flow coming in, so it again solves that cash flow issue there. But those are some of the people that we consider to be the happiest in retirement because they're still working, they're still out in the community doing things active, and they've got some money to fund maybe those extra vacations or kind of make up for some of those shortfalls in there along the way. So anyway, hope this video has been helpful. Hope you got some good ideas. If you like what we're doing here, once again, make sure you hit that like or subscribe button. And if you'd like to learn a little bit more about some of the financial planning that we do for clients, we'll put a link to our Wealth Vision financial planning page below this video. You can also set up a free introductory call with me, and if it makes sense, we can talk about next steps to doing a plan for you. Thanks, and I'll see you back in one of my next videos.